I don't hold bonds in my portfolio, and I likely never will. It's nothing personal against bonds, but they're poor long-term investments at their core. In this video, I'll explain why that's the case, and unlike most critics, I'll also share the alternative I use instead. And all I ask is that you watch this entire video with an open mind before lighting up the comment section. A lot of your questions and concerns will be addressed along the way. And then feel free to roast me after you put in the time. If you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please drip all over that like button, subscribe if you haven't already, and drop me a comment below with anything that comes to mind after you watch the video. And last thing, if you're interested in seeking alpha or snowball analytics, which are the two primary investing tools that I use and love, I do have a pinned comment below with my link to save you money when you sign up for either one of them. Make sure you wait for the juicy sales before using it. You know what time it is. Let's grow. Stocks versus bonds. Stocks and bonds are night and day different investing options. When you invest in stocks, you become an owner of the business. Your results are tied directly to the company's performance. Bonds, on the other hand, are simply a loan to a company or the government. They pay a fixed interest rate throughout the life of the bond. Bonds are generally considered safer, but they're not risk-free. Companies can still go bankrupt. High-quality bonds are usually safe, but the upside is very limited. Individual stocks, on the other hand, can swing your returns all over the map, way up and way down. But thankfully, we now have ETFs that make stock investing a lot easier. Thank you, Mr. Bogle. The S&P 500 is my favorite index. It's 500 of the largest US companies. With one ticker, you can own all 500, and the index automatically updates as companies come and go. This is why stocks, and particularly ETFs, are a better long-term play for your portfolio than bonds. Stocks always win. It's true, stocks will always protect your long-term portfolio value better than bonds. And I say this as someone who used to be on the other side of the argument. The two primary culprits are time and the reversion to the mean. US stocks have averaged about 10% per year for over a century. This isn't random. The data barely fluctuates because of the weight involved. Bonds have averaged about 5% returns over the same time period. But remember, 5% is not half of 10% once compounding kicks in. For example, if you invested $100 in the S&P 500 back in 1928, you would end up with about $700,000 in 2021. Not too bad. If you put that same exact $100 in the US 10-year Treasury, a quality bond, you would end up with $8,500, which is less than $700,000. Stocks and bonds always revert to their long-term mean. With our current form of capitalism, that's about 10% for stocks and 5% for bonds. And yes, of course, it's true that we can cherry pick stretches that bonds outperform, sometimes severely, and usually it's anywhere from 2 to 14 years, but long-term math always catches up. Bonds historically have outperformed inflation by just over 1%. The S&P 500 has never lost to inflation when dollar cost averaging in evenly over a 20-year period. Not one single time in history. At their worst, stocks are better than bonds long term. And I know what you're thinking right now. All this paper math doesn't necessarily reflect reality. For example, what if you've saved up $1 million over your career and you're ready to retire now? Would 100% VU, the S&P 500, make sense? What if the market crashes in your first year? What if 2022 happens again and you lose 18% or more right as you begin to live on your withdrawals? And I agree with you, VU, or the market, is not the answer here. But neither are bonds. They never are. Instead of that, what about a more defensive ETF that was only down about 3% in 2022 and has a fantastic long-term track record? SCHD pays and protects. SCHD is the best combination that I've found of the big three dividend stats: dividend yield, dividend growth rate, and total return. The dividend growth rate averages around 11% annually. That's insane long-term growth for your purchasing power in retirement. And the dividend yield sits at about 3.5% over the years. It really depends on the price. But the magic here is that SCHD has never paid less than it did the year before. Not once in its history. And many newer investors worry that total return is the elephant in the room here. But SCHD has been very solid when we zoom out. It outperformed the S&P 500 itself in its first 11 years on total returns. And then it fell short over the last 3 years for sure. But I think things will play out fairly well when we stretch it out over the long haul. The reason I say that is because SCHD's incredibly balanced methodology, which screens and scores for 100 blue chip dividend paying companies with stable balance sheets and consistent dividend quality. The results of this approach haven't always been sexy, but they have been remarkably stable. SCHD's worst year of total return on record in its 14-year history is negative 5.5%. Looking back further on the index it's based on, it actually did very well during the dot-com crash, although it did fall about 31.7% during the 2008 financial crisis, when the S&P 500 was down 36%. But then it bounced back with 5 consecutive huge positive years that surged to new highs. This shows that while anything can happen in the short term, SCHD has consistently provided a much more stable floor than the S&P 500. Time, reversion to the mean, and its defensive tilt make SCHD an amazing long-term cash flow holder compared to bonds. But enough chatter, let's move into the real-world example. The proof. It's time to put SCHD to the test against the Boglehead favorite bond fund, BND. And remember, this isn't the entire portfolio we're talking about. Most retirees will still have stock allocation to something like VTI or VU on one side. What we're comparing here is the bond side, the wealth preservation bucket. SCHD is a superior long-term solution for portfolio stability and cash flow that supports a fun lifestyle in retirement. I genuinely don't think you would believe the results if I just told you without showing you. Remember that torturous 30% drop that we talked about earlier? Yeah, we're fine. We're at our portfolio visualizer, which is my favorite tool to run these back tests. And you can see that today we're keeping it simple. For our 2 portfolios, portfolio 1, we have SCHD up here. In portfolio 2, we have BND. And you can see here, portfolio 1, 100% SCHD, portfolio 2, 100% BND. Okay, let's pop over to the settings and talk about what we're doing specifically. So we are pulling as much data as we can. I think it's going to be from 2012 through 2025 year to date on. I'll just leave this at the oldest here, 1985, but it's going to start when SCHD began. Now in this scenario, we have $500,000 right here that we're putting into SCHD or BND. Remember, we're retired. This is a portion of our portfolio that will be living off the dividends but not reinvesting. So we have our other holdings, and we're not advocating for putting 100% into SCHD or 100% into BND, but we are sectioning off our wealth preservation bucket. And our goals here are to preserve and grow our wealth and to get good cash flow coming to help our lifestyle in retirement. And you can see no cash flows, no additional contributions here. Rebalancing doesn't matter. There's only one holding each. Reinvest dividends is off. So we are taking the money and living on it, and we'll visit that to see which one cash flows better. And then display income on, so we can see all the information. I think we're ready to hit analyze portfolios. Okay, and as expected, we are pulling from 1/1/2012 through 9/5/2025. We're getting nearly 14 years of data here, which is a nice little sample size. Now we're going right down to the good stuff portfolio summary. Now, normally we're all about the returns, when we're trying to beat the market with our individual stocks versus VU versus VT and all that stuff. In this case, we're all about wealth preservation. We are not reinvesting dividends. So we started with 500,000 here of each, SCHD here and BND here. You can see that our ending balance with no contributions and no dividends reinvested is $1,584,000 with with SCHD and 444,000 with B&D. So we have literally preserved and grown well over $1 million by just putting 500,000 in SCHD and letting it sit there and spending, living on the dividends. B&D has stayed about the same. It's actually gone down a little. And usually bonds will stay flat on the price, and then you get your 3 to 6%, as most people know, for your yield, basically, if you're comparing it to a dividend ETF. Now, the standard deviation is going to be, of course, way lower with bonds, but 13.6 is below the market, below the S&P. Our best year here is 33%. That's great. It's a nice little bonus. More importantly, the worst year was negative 5.5. Best year with bond was a solid 9%. Worst year was negative 13, which is one of the worst years on record for bonds, to be fair. So this is kind of a rough sample size, but still 14 years is played out. And then these risk-adjusted ratios mean nothing in this, so we'll move on. What I wanted to touch on the portfolio growth. So as I mentioned, bonds here are the green one, and they'll stay pretty flat. You know, they've gone down a little. That's some bad luck, but usually this line, again, not including dividends, will be roughly flat, especially with treasuries and CDs and things like that. Whereas the blue line SCHD up top, you can see it goes up and then down, and then up and then down, and it crashed a little there. Come here to 2020 and you had a big drawdown. So you went from 1.1 million down to 859. Then you go way back up and down and up and down. But the point is you end at $1.6 million with all the ups and downs. So remember that 30% crash that was followed by 5 monstrous up years, or the .com that was followed by monstrous up years? It could get you down to here. 30% is a big crash, but ultimately you're going to get to here and then here and then here. That's that reversion to the mean. And when you have blue chip companies, now VU and VGT and QQQ, they would be way up here. But VGT and QQQ were also negative 30% just in 2022 when SCHD was basically flat. So this is a bit of a hybrid solution between bonds and those risky normal growth stocks. That's what I love about SCHD. It doesn't light the world on fire in the investing world all the time, like getting hate the last 3 years, but look what it's done versus bonds. But remember, this is only element 1 out of 2, preserving wealth. So clearly it preserves wealth well, even with some potential down years and then ups and downs and ups. Now on the total returns, again, nothing crazy to see here because this isn't really the point. We more want to zoom out and see where we're at, like we did above. But you can see SCHD has some big years. It has a down year here, another down year here. Bonds slightly down and slightly up. That's just the nature of them overall in general. And just for context, these trailing returns, annualized return does include dividend. And so when you zoom way out, we won't get into all these like we usually do with most investments, but you can see SCHD here is at a very nice 12.24. Again, trailing the market, which is more like 14 or so in this time frame, but still a solid 12.24% growth. And bonds are getting you a positive 2%. So again, kind of battling with inflation like they always do. When you zoom out, things look pretty good there with SCHD. But we need that second piece we were talking about. We saw the wealth preservation with SCHD and the advantage there. Now let's talk cash flow. In year 1, bond paid more than SCHD. And it's not crazy atypical at any one snapshot in time, the quote unquote current yield, which does not matter for investments. It only matters the day you buy it, will commonly be higher, kind of like money markets and stuff like that's been getting 5% the last few years. So people say that's more than SCHD and it just makes me cringe because they don't understand compound math. Because as we go year by year, you can see SCHD takes the lead. And let's do some examples here. And I'm just going year by year. I won't read them all off, but SCHD is over double now comfortably. And when you get to like 2023 was a pretty good year for bond and money markets and stuff like that. The yields were going up quite a bit. You got 13,000. And at the time you were getting 5%. But remember, it's 5% on whatever value you have. So it is not more than SCHD. That day in a vacuum, yes, for that new current yield, but the yield on cost is all that matters in reality because this is what actually hits your pockets. So when 2023, when SCHD was yielding 3% and change, it was actually yield on costing. Again, what you actually get based on your $1.5 million, the lower yield on a higher amount, you are getting nearly quadruple what those high rates were doing. Because remember, your yield is double digits now. If it says 3.5 or 4, that's irrelevant when you retired and dumped it in because the yield on cost considers considers your dividend growth rate. Current yield never considers dividend growth rate. You got to remember that. It's all what it does for you. And a quick note, for whatever reason, the second dividend of 2025 is not in here. SCHD is actually about 6% ahead of last year right now. And it's really about here or so. For some reason, it's still down here. So it's counting BNDs mid-year, but it's only including a quarter of SCHD for whatever reason. And the hilarious thing is SCHD is still higher because you can see this is the last complete year. $57,000 compared to 15.7. So remember, these high current yields, please don't get enamored with that. It'll crush your purchasing power in retirement. Let it ride, let it grow. And SCHD is superior for your cash flow, and it's arguably more superior for your wealth preservation. I'll be making this video a yearly staple to keep myself accountable, just like a few of the other series that I run. I have no doubt that this trend will continue long term, even if we have a couple terrible years in the stock market. Zoom out, smile, and enjoy the good life. And speaking of good people, I'd like to give a huge shout out to my new channel member, Stephanie. I really appreciate your support and all of you that have been here all along. It genuinely means a lot to me, and it's the best way that you can support the channel. And check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.